In this week's video, we'll review the charts and the hard data to help us answer the question, are stock market trends starting to roll over? We'll also look at the psychology of the markets to help us address this question. Why does the present day always seem so hard and uncertain? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. In order to get a better handle on the recent volatility in the markets as of Friday, August 18, 2017, let's look at two very vulnerable points in history. Basically helps us understand what a long-term uptrend rolling over into a long-term downtrend looks like. This is the S&P 500. This is calendar year 1999, calendar year 2000. We're using daily charts, and for illustrative purposes only, the 100-day moving average in blue all the way out to the 290-day moving average. We're moving in increments of 10. These are generic daily moving averages that we chose for illustrative purposes only to illustrate basic concepts about trends. At this point in calendar year 2000, and if you know your market history, really bad things started to happen after this point here in November of 2000. This is somewhat of our line of demarcation where things started to change. Price came up here and failed trying to retake these moving averages and then started to move in this direction. Similar situation here in 2007. We've removed price because we're using moving averages to help us filter out the day-to-day volatility with price. Similar situation here. Late December 2007, price was below the moving averages, came back up, tried to retake them, and failed. And in both cases, as these moving averages were rolling over in a concerning manner and getting into that concerning tight cluster look, price did something else in this window that was concerning. On the left side of this yellow line here, we have a bullish bias. Price stays above the moving averages, so when it pulls back, it rallies at or in the moving averages. It never breaks into this white space here. Notice the bias during the bullish period, the slopes are up. Here's where things start to change. Now, instead of having price come down into the moving averages and rally, in this case at the yellow line, it clearly breaks through to the other side. So now price is below our moving averages. This looks different than anything that we could see on the left side of the chart. Then when price tries to retake the moving averages, it fails here and bounces back in this direction as the moving averages are rolling over. So this helps us understand what a bullish bias looks like and what a bearish bias looks like. Pretty much the exact same thing happens in 2007. Even though the fundamental concerns were radically different, the math works the same way when a trend rolls over. If you looked at this chart with price, on the left side, we get rallies, counter-trend moves, rallies, counter-trend moves, rallies, counter-trend moves. Price stays above the moving averages on the left side. Here's where something changes. Now price breaks below the moving averages for the first time here as they're rolling over. It's not a good look. And then price comes back up into this area right here, right around 1500, late in calendar year 2007, and fails trying to break back through and moves in this direction. It's not surprising that these transitions are similar because the math works the same way really in all instances. There are some just variations and permutations of the same themes. When price is above the moving averages and the slopes are up, the odds favor higher highs being made after pullbacks. So when you pull back, if you're patient, the market's profile tells you most likely your patience will be rewarded with a higher high. Most likely your patience will be rewarded with a higher high. Once we get into this area here and things start to change, that's not true anymore. Now when you go up here and fail and price comes back in this direction, now the odds are telling you that price most likely will go on to make lower lows and lower highs. Price will most likely go on to make a series of lower lows and lower highs. The math is very, very similar in a correction. The only difference is the weakness doesn't spill out to these more lengthy time frames here, but we would see something very, very similar with our shorter term moving averages. In these cases, our longer term moving averages and our shorter term moving averages are rolling over in a concerning manner. Therefore, in the present day, all things being equal, our concerns would increase if these moving averages were getting into a tight cluster and rolling over, if price was below the moving averages, and the slopes of all of the moving averages were down. So what we don't want to see is a cluster, price below, and the moving averages rolling over. How does the exact same chart using the exact same moving averages look on Friday, August 18th, 2017? Here's the answer. Do we have any of the things that we wanted to avoid? Is price below the moving averages as it was here and as it was here? Price remains above all of the moving averages. The slopes on all of the moving averages are positive, and blue, our fastest moving average, is still on top on Friday, August 18th. That's quite a bit different than our look in here and our look in here. This profile tells us that we still have strong, longer-term trends. It doesn't mean the stock market's going to go straight up from here. What it tells us is, much like this pullback here in November of 2016, and much like any pullback on the left side of this chart, and any pullback on the left side of this chart, volatility is part of the equation. It's just that when the market comes down into the trend, typically, or the moving averages, more often than not, it's going to rally and then go on to make a higher high. So in the present day, if we move in this direction, the odds right now say that price most likely would find its footing somewhere inside of this cluster, even if it went all the way down to this point here. And then after finding its footing, most likely with a profile like this, if we held and classified it as volatility to ignore, price would go on, most likely, to make a higher high. If our present day chart looked like this or this, that wouldn't be the case anymore. It's pretty clear to see, based on the facts that we have in hand, staying in the now, we still have a long-term and clearly bullish bias. Let's talk about why it's extremely important to keep that flexible, unbiased, and open mind, and to always maintain that maximum we have no idea what's going to happen next flexibility stance. When the math starts to roll over, the only way we'll be able to see it is if we're open-minded and flexible. And it's extremely important when we start to see math like this that we remain disciplined and take action. Why? Because when the probabilities are unfavorable, really bad things can happen. In this case, price was at 1430 here when we could see this, measure it, and put it in a model. After that, really bad things happened. We fell from 1430 to 768. Similar situation here. Price was right here, right around 1500 in late 2007. After we could see all of this damage, measure it, and put it in a model, really bad things happened. On the left side of these charts, it's prudent to keep our capital in harm's way. On the right side of these charts, it's prudent to start moving our capital out of harm's way. From this point here, where we could see the deterioration, the additional loss was 46% in the S&P 500. From this point here, where we could see the deterioration, the additional loss was 56%. In the present day, the S&P 500 and our core positions, as evidenced by the look of these moving averages, are still in what appears to be a strong long-term uptrend, where any moves in this direction most likely would find their footing and be followed by a higher high. Is that true for all of our positions? No. If you're a client, you may have noticed that in some accounts, we cut back on one of our weaker positions. Why did we do that? Because that position has a profile similar to the profile in this box here, where the math is starting to deteriorate in a way where the risk-reward ratio is about a coin flip. This position, this is the second time we've cut this position. We're migrating away from this position until it can prove itself. When we have this type of profile here, right here, we could still see a big move in this direction, but unfortunately we could see a rapid and big move in this direction, and that is why we reduced exposure. Notice this is a non-SPY position that we reduced on Friday. This has absolutely nothing to do with the bigger picture, and nothing has really changed relative to the bigger picture. This is position specific. Good news, if you're a client, taking action here with that position shows that we are ready, willing, and able to take action when the evidence changes. And we will do the exact same thing if the present day chart for SPY and the S&P 500 morph into a look like this. As we can see on August 18th, that hasn't happened yet, and we manage based on the facts in front of us. We've shown that the present day really doesn't look like the early stages of a new long-term bear market. Let's shift gears to more constructive and favorable historical setups and ask what we can learn. These are the same daily moving averages that we've been looking at. This is January 17th, 1996 here. This is 1995 out here. The profile that we're looking at is in early 1996. This is 2012 here. The profile that we're looking at in this case is in calendar year 2013. It's pretty obvious that in both cases we have a bullish bias. If I had price on here, the bias is for price to stay above the moving averages, and the slopes of the moving averages are all clearly bullish. What happened next in these cases? Just like the bearish case, we're simply looking at probabilities here. The probability of good things happening long term is higher, quite a bit higher than the probability of bad things happening from a long-term perspective. In this case, in 1996, the S&P 500 tacked on an additional 156% as it rallied into the spring of calendar year 2000. In this case, in 2013, here, the S&P 500 moved from roughly 1690 to roughly 2134 with a profile like this. That's an additional gain of 26%. Does that mean that's what's going to happen in the present day? No, it simply speaks to probabilities. And in the present day, our current profile looks a lot more like these constructive profiles than these concerning profiles. Now we're going to transition into volatility and the psychology of the markets using these charts as a basis for our discussion. Why are we constantly showing examples of historical volatility in these weekly videos? Because we know when volatility rears its ugly head in the present day that it's very, very difficult. And the more we can understand about normal volatility, the easier it will be psychologically to step outside of ourselves and act rationally instead of acting in an emotional or irrational manner. Let's quickly look at a clip from one of our videos from February 17th of this year, and then we'll tie it into the present day. Similar situation in the 1995 example, a lot of volatility with price. If we overlay our 100, 200, and 300 day moving averages, we can see the trends Despite the volatility, the longer-term trends remained strong, telling us there's a high probability that these pullbacks will be followed by higher highs. So now we're back to August of 2017. In the clip that we just saw, the pullbacks in the S&P 500 ranged from 2.17% to 6.03%. And when we look at that clip, with the benefit of hindsight, it's very, very easy to understand. Yeah, it's normal. Markets pull back, then they go higher. They pull back, then they go higher. But when the volatility is right in front of us in the present day, it tends to be quite a bit different. Therefore, how does the volatility that we've had in recent weeks compare to the volatility that we just looked at in the clip from February? This chart, S&P 500 daily with high-low close as of August 18, 2017. The pullback from this high here to this low was less than 2%. That's 100% normal and to be expected volatility within the context of an ongoing uptrend. And the present pullback has not even hit 3% as of August 18th. Both of these figures fall well in between the range that we covered back in February, basically saying, get ready, volatility absolutely positively is coming, and it will be part of the future. Well, we're in the future now, and none of us should be surprised by a pullback of less than 2% and a pullback to date of less than 3%. If you watch these videos regularly, and I presented these two charts on a multiple choice test and asked you, do odds favor higher highs or lower lows? It'd be very, very easy. You would pick odds favor higher highs because that's how bullish trends work. You make a series of higher highs and higher lows, a series of higher highs and higher lows. Why does it appear to be so easy? You wouldn't even hesitate here. You would look at this chart and you would say bullish. The odds favor bullish outcomes from a long-term perspective. It's easy with the benefit of hindsight because these historical charts are stripping out. We do not have to deal with all of these common things or slip-ups that we make as humans. We're not watching the market tick by tick when we look at this chart today. We're not watching our profit and loss too closely. We're not thinking about bearish forecasts. We're not watching TV when we look at this with the benefit of hindsight. When we look at this today, we're not worrying about what everyone else is doing, what everyone else is saying. We're not trying to avoid volatility. We're not fearful of a pullback when we look at this in the present day. We're not fearful of the next bear market. And we're not going through all kinds of if this happens, the market could do this scenarios. When we look at this chart here from 1996 in calendar year 2017, we don't have a short-term focus and we're not fearful because there's nothing fearful about looking at a historical chart. In short, the historical charts look and feel so easy because the historical charts are stripping out. There's no money involved here. Our egos aren't involved. Our emotions aren't involved. We're basically stripping out all of the psychology that's required to navigate from a point A to a point B. And in order to navigate from a point A to a point B that could occur years from now, the hardest thing is mastering ourselves and overcoming all of those common missteps. When we look at these charts in calendar year 2017, we're not reading the newspaper. We don't know what the concerns of the day are. We probably think it was easy back then, but I can guarantee you, I worked on Wall Street. It's never easy. It never feels easy in the present day. Having said all of that, do these charts, which we think are easy, this is easy, do they look materially different from the present day, which seems to be so hard? Why is it so hard to withstand a 2 to 3% pullback, even though we know that that's normal within the context of an ongoing uptrend? We also know that the odds tell us higher highs after a pullback are probably in the cards. Nothing is certain, and that's why we have to remain flexible and take it day by day. We prove that on Friday by cutting our weakest position. That discipline is a reflection of our flexibility. So why is the present day so hard? Why was this week difficult? Why was the previous week difficult? Because unlike these easy charts here, in the present day, we're putting our money, our egos, our emotions, the psychology of the markets, and mastery of self all back into the equation, as well as the concerns of the day. This, in real time, is much, much harder than this or this with the benefit of hindsight. The proper way to use these charts is to make a decision the exact same way you would historically when you're able to strip out all of the things that make the present day difficult. So if we looked at this chart on August 18th, 2017, and we looked at it 3 years from now, it would probably be just as easy as this chart and this chart. Human psychology is basically the answer to the question, why is the present day, no matter what the charts look like, why does it always seem so hard? Let's look at a Psychology Today article. Cognitive biases are bad for business. Do you see irrationality in your company? The article talks about informational biases, a knee-jerk bias, a razor bias, the silo effect, a confirmation bias, a myopia bias, and there's also biases, common biases related to our egos, a shock and awe bias, a homecoming queen, homecoming king bias, and a force field bias. We all have these biases in some shape, form, or fashion. Our challenge in the present day is to understand that and respect that and learn how to step outside of ourselves and our biases and look at the chart in a rational and unbiased manner, which is much, much easier to do if you know that you will take action when the chart inevitably rolls over. The bullet points that we're about to cover apply to every single day of every single year, including what appears to be an easy point in time here and an easy point in time here. I can assure you, if you were living these markets here, this wasn't necessarily easy and this wasn't necessarily easy. Why? Because 365 days a year, no matter what calendar year we're looking at, there is always, without exception, something to worry about. Geopolitical concerns, fundamental concerns. You can always find things on the charts that are concerning, and there are an infinite number of what-if scenarios that we can run through on any calendar day of the year. In summary, every single week of the year, we could make a list of scary things regardless of the market's profile. And if we make that scary list and collect that data rather than looking at the weight of the evidence in the big picture, that list will greatly increase our odds of falling prey to one of the common missteps that we always cover in these videos. This present day chart is looking at all of the concerns in the present day and balancing them with all of the positives of the present day. If the concerns of the present day start to matter, which could happen as early as next week, then the charts will start to reflect that. And instead of having slopes that look like this, we'll start to see some of these slopes flatten out and then roll over. And if we get a dislocation out of a chart like this, when the numbers look good and the market plunges in this direction, typically down here is a buying opportunity and the market goes on to make a higher high. So the purpose of this video is not to say that in 2017 the S&P 500 might not fall further in this direction. The purpose is the odds also say that it will find its footing somewhere inside of this band, most likely, and then it will go on to make a higher high. And since our North Star is trying to navigate between a point A and a point B that could be several years out in the future, if we are disciplined during these 100% normal and to be expected pullbacks, the odds, probabilities tell us that the volatility will be followed by a higher high, that the volatility will be followed by a higher high, and the volatility will be followed by a higher high. And when the present day morphs into a look like this, we also understand that the probabilities will begin to shift and we will have to adjust accordingly, just as we did with one of our positions, a non-SPY or core position, on Friday, August 18th. We track all of this and convert it into a usable and actionable format in a reasonable amount of time. The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.